So this is what happened in the last, actually end of last week and the beginning of this week, which was Monday. Okay, so Japan had a Black Monday. The Nikkei was down over 4,000 points, and the points were down more than the Black Monday in 1987, right? So historically, Nikkei has never dropped this much. But actually, in percentage term, it wasn't as bad as the Black Monday in 1987. Okay, so naturally, when the numbers go bigger, of course, when they drop 10%, 10% of 30,000, 40,000 points versus 10% of 10,000 points, of course, there are differences, right? So in percentage term, it wasn't that big, right? But in terms of number of points, it was that huge. And there were other news over the weekend. You hear Warren Buffett sold half of the stake in Apple. So people were like thinking, did Warren Buffett know something that other people didn't? Did Warren Buffett sell because he thinks that the market is going to crash, right? Or something bad is happening to Apple? We won't know exactly what he thinks, but I'm very sure he didn't sell because he thinks that the market is going to crash. Okay? Because that is not his investment style. And he is known to invest for the long term. He is known to buy and sell based on the business quality, which he believes whether he has that longevity, right, of that business quality. So he doesn't. It's very unlikely that he sell because he thinks market is going to crash. Because historically, he has always held through majority of his investment through the boom and bust in his stellar decades of experience. All right, so don't read too much into it. That's what I'm trying to say with regards to the Apple investments. And for NVIDIA, there was also another big issue, right? The new chip, the Blackwell chip, supposed to be the next big AI chip that most other big techs or AI companies will want to buy. And there was an announcement that it was going to be delayed. Okay, there were some design flaws that need to fix before they can be produced by TSMC, and that will take some time. So that also caused certain fear because AI stocks has been the one that's driving the market upwards. A lot of the stocks did not really go up that much for this year, where people talk about it was a very narrow bull run, right? Majority of stocks were actually still pretty much stagnant or even down for the year. And if AI is not there to drive the stock market, then who is going to be? And no one else. And that's why people also start to worry, is the AI bull run trying to get unwind as well. And of course, the US market wasn't good. If you open up on Monday evening, you see all rates or majority rates are there. See some green shoots, but majority overwhelming, and more than 5,000 stocks were in a red. That was what happened yesterday night. Today seems a bit better, right? Nikkei opened up around what, 10%. Okay, but if you are down 10%, you're up 10%, you're still below water. Okay, so because you need a lot more returns in order to get back to where you were in percentage terms, and therefore it is still on shaky grounds, right? It is totally not out of the woods yet. We cannot at this point in time say that even if we believe this is a correction, we cannot say that the correction is done at this point in time. Okay, so this is the background, right? Especially for those who went on holiday, didn't know what's happening, but I doubt so because your social media feed, your news feed will be filled with all this market crash information for this past few days. Okay, so now let's go through what are some of the things that you should know, okay, and understand the background, what caused this crash. There are some, this is the VIX index, which is the volatility index of the S&P 500. Essentially, what it means is that when the market crashes, this VIX number will shoot up. And what's so special that we need to talk about this? Of course, it will shoot up, right? Yesterday, it shoot up to 65. Okay, 65. Normal market should trade around, the VIX should be around 10 plus, right, in the teens. But yesterday it shot to 65. Okay, and what is so special is that it is even higher than COVID. It is even higher than Great Financial Crisis in 2008. It's even higher than the dot-com crisis in 1999, 2000, that era. Okay, so it sounds very scary, right? Because all these followed by major market crashes. Okay, so is this a prelude to a market crash because the VIX has spiked up so much? Right, so this is just one of the many indicators. We will look at a comprehensive suite of them, and thereafter we make a more informed decision. Okay, but I would say definitely there are indicators that don't look good, right? There are indicators that look good. Then that's what complicates things. Okay, because if it's half-half, then what do we do, right? So I'll give my views by the end of my sharing. There are a confluence of factors. Okay, so the first is people talk about the yen carry trade unwinding, and the second is the US fear of recession. Right, some people think that, or the market think that the Federal Reserve is cutting rates too slow. Okay, like how they raise rates too slow, that causes inflation to rise up for a considerable amount of time before it get reined in. So this time around, they also believe that the Federal Reserve has cut rates too late. Previously, last year, people were expecting that the Fed should cut rate in March this year. Okay, and by August now, 5 months later, they haven't thought about cutting rates. Actually, they have been starting to talk about cutting rates, but they haven't really exactly cut rates yet, probably until next month. Okay, so there are these factors that are brewing in the background, and therefore it caused some investors to be uneasy, and they took action to sell, right? And enough people sell that cause, and not enough people buy, that cause the prices to fall rapidly, because you need to sell it cheaper in order to attract more buyers to come in, right? So that is how the market works. This is the build up to the yen carry trade. Okay, so what's going on is that Japan has defied the global trend. Okay, a lot of countries have experienced inflation. Actually, Japan has also experienced inflation. It's just that their inflation is not as high as the other countries, and also because Japan has been in deflation for decades. And when they see inflation, right, it is something that they should celebrate. Okay, they are not in a hurry to to raise rates, to hike rates like the US or Europe, and they really bask in the joy of this higher inflation, which they have not seen for a long time. And they maintain at very low interest rates, right? And they were the one that still were at below 0%. That was as of June last year, June 2023. So we take a bit of time capsule back, not time capsule, time machine back to those period. Okay, they actually cut interest rate instead of just holding, right? So they were actually at negative interest rate. They wanted to take the opportunity to stimulate the economy. Okay, so that was the choice. We are not uh, the actual economies making the decision, right? So that was the decision that's made for them, and we should not comment as good or bad. But because the rest of the world has been hiking interest rates and Japan has cut rates, it makes the Japanese loans cheap. So investors could do the so-called carry trade. They could borrow Japanese yen at maybe 1+%. Okay, it cannot be 0%, okay, because the bank need to make money, right? They need to do a bit of markup. So they will maybe mark up about 1+% to lend it to you. And it is still cheap, right? Imagine you get a Sing dollar loan, you get 3-4%, you get actually more than that, 5%. You get a USD loan, maybe I don't know, 6%, 7%. Okay, there's always a markup to the base rate. So it is expensive to borrow in other currency, but yen is exceptionally cheap. So that attracted a lot of investors to do this carry trade, borrow yen, and then you invest elsewhere. You can invest in Japanese stocks, like what Warren Buffett did. You can invest in US stocks, because some people believe the AI run is going to be a lot. So they borrow yen, convert to US dollar, buy US stocks. They could buy India, they could buy Europe, right? Whatever they want to do with the money. Okay, or buy cryptocurrency also can. So they borrow yen. Okay, so that is what gave the build up to the massive Japanese yen carry trade. Okay, because of this interest rate disparity. Everything was good. And this interest rate differential also caused the yen to depreciate and the US dollar to appreciate. Okay, because when interest rate is high, right, and the US keep hiking interest rate, right, it strengthens the US dollars. Okay, and when Japan cut rates, it weakens the yen. the central bank has tried to do some intervention in the past, right, to strengthen the yen, but no country can actually intervene successfully. Historically, it has always failed. You can only prevent the fall or the weakening for a short period of time. But once you stop buying and supporting the yen, the currency, it will start to weaken again. So that was what happened. And you can see since 2021, when the Fed started to hike interest rate, the relationship between dollar and yen continue in the same trend. Okay, USD strengthen, you need more yen to exchange for the same US dollar, right? So that's why the amount of yen needs to exchange goes up. There was a period that came down a bit, but then generally is on the uptrend. Until recently, you can see this very sharp fall. Okay, this is not an intervention by the central bank. This is unwinding of the yen trade. Okay, so that's why there's a sudden fall. Why is this happening? Because the relationship reversed. Okay, Japan hiked the interest rate to 0.25%. It surprised the market. And at the same time, US talked about cutting rates in September. So what was going on well now reversed the opposite direction. Okay, which also means that it becomes more expensive to borrow Japanese yen. Okay, and then the the yen will strengthen, right? And at the same time, the USD is weakening because of the impending rate cuts that's going to happen in September. So the widening interest rate difference actually narrowed down, right? It converges. Okay, so that caused maybe some investors, they got margin call, right? They leverage too much, and then this happened. They don't have enough maintenance margin. They got margin call, they couldn't pay, or some losses are very big. They decided to cut loss. So that caused a lot of that selling, okay, to redeem their loans in yen. So they need to sell a lot of investment all around the world, right? Wherever they borrowed to invest in, they need to sell, get the money, and return it to the banks in Japan where they borrowed the yen, okay, or any other banks that they borrowed the yen from. So that was what caused unwinding. And this massive yen carry trade unwinding, we do not know whether it has completed or not. Okay, Japanese bank has lent out $1 trillion to foreign borrowers in yen as of March this year. And that was up 21% since 2021, 3 years ago. We don't know how much of this yen carry trade has been unwound. We don't know how long more it needs to unwind, right? And worse is that as time goes by, the yield spread will continue to compress, which may urge even more investors to unwind this yen carry trade. Okay, and because it's also leverage, which means the margin call can happen very fast if any extreme movement happens again. Okay, because if people sell down, price go down, it triggers more margin call, right? It becomes a vicious cycle. Okay, so that is how it happened over the last data half of last week. Okay, so that is what has probably caused the market to be panicky. But if we take a look at the bigger picture, right? Japanese interest rate is at 0.25 at the moment, okay? And US interest rate, they haven't cut yet. Not interest spreads, interest rates. 5.25 to 5.5%. The spread is still a lot. Okay, the interest rate just increased by 0.25, so much reaction already. Okay, but the carry trade actually is still valid, right? So it just depends on how aggressive some of the borrowers have been engaging in this trade. If they didn't borrow a lot, they didn't leverage a lot, it could be a case where the carry trade is still valid, right? Yeah, they may have some paper losses, but it's not something like they need to top up a margin at this point in time. But it shows that how sensitive it is, and it is also a reflection of how much of the yen carry trade has been in the market for all this while. All right. So we will know how much more is unwound. But all in all, I can say that this yen carry trade unwinding is a temporary thing. It is not a permanent thing. Once it stabilizes, then this risk is no longer there, right? Because now this is a known risk, and I think that people who are afraid of the situation that they may get stuck in have probably exited pretty much, right? And then the remainders are probably not so geared up as much as those who first exited. Okay, so given that today the Nikkei rebounded quite healthily, right? Okay, I think that this is a temporary problem. Okay, The longer term problem is the second problem, which is the US economic slowdown, which may lead to a recession. Okay. In some of the previous situation, right? In other sharings that I've done at the start of this year or even last year, I talk about because everybody is talking about wow, rate cut, rate cut, rate cut. Right? Everybody seems very happy. But if you look at it historically, right, the rate cut usually don't bring good news. Right? Okay, like in 2000, they cut rates, S&P 500 was falling, okay, crashing, not just falling, crashing. Then in the 2000 financial crisis, they cut rates. Of course, it was a GFC that caused the market to crash. And in COVID, okay, it crashed as well, right? Just a short while when during the rate cut period. So now they are talking about they're going to cut rates in September. Okay, we have seen this many, many times in the past. They cut rates, bad things happen. Okay. But if you think about it, right, it's not actually the rate cut that caused the market to go down. It's more of why does the Federal Reserve need to cut rates? Okay, or maybe a better, more detailed phrasing is why does the Federal Reserve need to aggressively cut rates? Okay, so that is the more important question. It's not because they cut rate then the market fall, right? It doesn't make sense, right? It's more like something bad happened, they cut rates, but it's too late. That's why the market fall. Okay, I hope you will get a logic chain over here. This is another view, but it's the same, talking about rate cuts, and then it's followed by S&P drawdown. And you can see the drawdowns are typically quite large. Okay, of course, sometimes it's smaller, but if you take a look at this period, it's actually quite close together. It could be just some aftershock, like what an earthquake does. But they can be down like double-digit percentages. Okay, but some you can argue that this is more like a correction now, right? It's not really a crash. Okay, but there are many instances that actually led to a crash. Okay, so this is one of the bad indicators, just like the VIX spike. Okay, it shows that it could have more downside come. And let's look at the economic indicators, right? So there's another concern that investors had was they look at the manufacturing PMI, which is below 49, right? So in the US, they say that actually a 49 is considered anything above is expansionary, below is contractionary. So it's contracted for consecutively 3 months really. Okay, the July numbers was just out yesterday. But of course, people argue that US is no longer a manufacturing powerhouse. The economic growth is not dependent on how much US is manufacturing, which is fair enough, right? Then they were looking at the services PMI, and it wasn't good because in the June period, it was very low, right? It was low, one of the lowest in like 2 or 3 years. Okay, the reading below 49, it was in contraction. The only good thing was this morning, right? They reported that the services PMI shot back to above 50 or above 49 in this case, right? So it's give a sign or breathe a sign of relief, right? So this could maybe show that the economy still has strength, right? And also US GDP has also grown higher than expectation in the last quarter, second quarter. Okay, so this a bit mixed signal coming from the US economic indicators. And another contentious indicator was the unemployment rate is climbing. Okay, and also Jerome Powell, the Fed chairman, he also have shown some concerns, right? Because for the Federal Reserve, they have two mandates. One is to combat inflation rate, but one is to have a healthy employment rate. But when you raise interest rate too much, you tame inflation, but you cause unemployment. If you cut interest rate too much, you will fuel the inflation rate, and you will, of course, help with employment rate at the same time, right? So they have this dual mandate that need to balance. Okay, so you can see that the stance of the Federal Reserve now is shifting from inflation issue to employment issue. Okay, they have started to worry about the job market, and any negative job results will cause the market to sell down again, right? And of course, that may also cause the Federal Reserve to cut rates more aggressively. So you can see how it comes together. So it's actually the worry of a recession that caused the sell down and caused the Federal Reserve to cut rates aggressively. Okay, so when this thing happen, then the market may crash. Okay, and another indicator is the yield curve inversion. This is a sign where the recession may be happening, right? So they use this 10-year bond minus 2-year bond. By right, 10-year bond minus 2-year bond should give you a positive number, okay? But when the yield curve inverts, it becomes a negative number, right? And historically, whenever the yield curve inverts, a recession will follow after. Okay? But to be more specific, is when the yield curve uninverts, then a recession follows. Okay, so a lot of people were saying that no, this indicator is not accurate this time, right? It has been inverted for so long, but we have not seen any recession in the US yet. But if you take a look at the past, as I said, it's not the inversion, it's not the first point where the graph goes to zero that caused the that caused the recession, right? It's usually thereafter when they go above zero. Okay, when they go above zero, that is where the recession happens, right? See? Okay, so this pocket to orientate you. The gray part is the recession part. Okay, the gray part is the recession part. You can see it's always when they turn positive, then the recession happens. When they turn positive, I think then the recession happens. Okay, so now the curve is going to turn positive again. Okay, so which means US is not out of the woods. A recession may still be possible. Okay, which also means that the soft landing is not materializing as what the Federal Reserve hoped to achieve. And that is what is causing the sell down in the US stocks, because if the economic slowdown, the recession is going to happen, a lot of the future earnings will be much lower than what the market has been predicting, right? Because the market is a forward-looking mechanism. And typically, if this is true, the market will crash first. Then you will hear an official announcement that a recession has started, right? Because the market is always leading the economy. It's not like they will announce recession, then the market crash. It doesn't work like that. Okay, so now you can see that the market is already reacting to a new probability that a recession may be happening. Okay, if we take a look at the related to the yield curve, right? Because the Federal Reserve will have the power or the influence to manage the short-term interest rate, which is that 1 year kind of time frame. And the interest rate that the futures market, so these are futures market, which will change based on what the market thinks. But the market so far has always been good at predicting what the Federal Reserve will be doing. And usually there's not much surprises. So the September rate cut is expected about 75% chance that they will cut the interest rate by 0.5%. Okay, previously they were predicting it would be a minus 0.25% or a 25 basis points. But now the probability has increased to a minus to 75% chance that they will do a 0.5% rate cut to bring it below 5% in the US. Okay, and in November, the majority predicts that there will be another 0.25% rate cut. Okay, and in December, majority believe that there's another 0.25% rate cut. So altogether, by end of this year, a 0.5 plus 0.25 plus 0.25, we are looking at a minus 1% rate cut in 2024, bringing the interest rate down to 4.25 to 4.5%. This is what the market has adjusted. Okay, so the market went down, they adjusted for this. If the Federal Reserve look at the news or the economic indicator is bad, they cut more than this, I can tell you the market will adjust once more and it will go down even more. Okay, so this is where the market think the Fed is going to do, right? But this is subjected to new information and changes to the market developments. Okay, so the bad news is that the more the Federal Reserve cut rates, that means the more to worry about the economy. What you want to see is that the Federal Reserve cut rates, but don't cut too fast. Okay, that also means that the economy is strong, right? So now you can see actually cutting rates is not so good. Aggressively cut rates is not so good initially. Eventually, yes, the market will rebound and return to its bull run, but not without that shock first. Okay, they need to clear that shock first. They need to make a major readjustment because the forward projection will change dramatically. Okay, And the bond yields, the bond market has been reacting as well, right? They will act in tandem because the markets are all correlated one way or another. These are the US Treasury bond yields. You can look at the 10-year bond yield. It has gone below 4%, okay, as of yesterday. And you can see the green line is 1 month ago. Yellow line is, orange line is 6 months ago, right? So you can see this dropping. The yields are dropping. And a proper yield curve looks like that, right? The longer the tenure, the higher interest rate you should get. Okay? An inverted yield curve looks like that, which is something like this right now, right? It's an inverted yield curve, which we talk about. So when they start to cut this short end of the interest rate, right? So if they cut 1% by end of this year, this point will come to this point. Okay, so you can see the yield curve is slowly uninverting itself. Okay, I cannot use slowly. If they cut aggressively, it will uninvert very fast. Okay, and then the speed will also cause a lot of turmoil in the market, right? So that is the uninversion that's going to happen in within the next 6 months or beyond. Okay, so these are the picture, and there will be increased demands for bonds, right? Why? Because stock investors, some of them will panic because they see the stocks come down. What they will do, they will flight to safety. It is a very common behavior. When the market volatility spike up, fear increases. Some cannot take it anymore, sell the stocks due to fear, and they go and buy bonds because safer, right? Relatively, they feel safer. And for bond investor, they will also buy more bonds. Why? Because they want to lock in a good yield now. If interest rate is going to get cut, they are not going to enjoy that maybe 5-6% that they are having right now. So what they will do, they will buy more. That will increase the bond demand. And what will happen? Bond price will go up. Okay, and it's also very sure because bond interest rate and bond price move in opposite direction. If bond interest rate goes down, of course, bond price will go up. So there is a lot of that support for higher bond prices. And you can see, even though the stock market is going down for the past 5 days, these are the varying treasury bonds, 1 to 3 year, 3 to 7 year. These are the ETFs, and the 10 years, 10 to 20 years, 20 plus years. You can see all went up. Okay. And then when people see this go up, they will sell stocks and buy more bonds, right? Because they bet that the interest rate cut will increase the bond even more, bond price even more, and benefit from it. So the longer the tenure, the more volatile the bond prices are going to move. Okay, so that is what's happening. So that there actually, I think that there are two scenarios. Okay, that may happen from now, right? I already mentioned that the yen carry trade should be a temporary problem, but this recession, US recession, is a longer term problem or a mid-term problem. Will last, if it's a recession, right, it can last until next year, okay, before you hear the official announcement. So the second scenario is that a recession happens, right? So what happens is that I actually shared this at the start of the year to my insider group. Okay, we had a mentoring session. This is the exact slide that I showed. The economy turns weak, right? Unemployment rate goes up, okay, which is happening right now. Okay, market sells down. We also have been seeing this. Then in September, Fed cut rates, right? You can see the order of things. And recession will only be announced officially thereafter. Maybe sometime next year. If a recession is happening, I believe the announcement will be next year, not this year. Okay, there's always a delay effect. And the official agency to announce a recession is this NBER, National Bureau of Economic Research. Okay. Yeah, I just make it up. Okay. But I think it should be somewhere around similar words. Okay. But that is the agency to announce, and it's subjective. It's up to their interpretation whether US is in recession. Okay. But I think it's likely to be next year, right? Especially it should be done after the election end of this year, right? You don't want to jeopardize any of the, especially the incumbent. Okay. And the market bottoms, right? Why do I say that? Recession is actually a buy signal, right? It's not a bad news. Okay, if US officially announced that a recession has happened, it's actually a bottom indicator, because you can see 1 year and beyond, the S&P 500 most of the time, more than 90% of the time, is positive one. Okay, after the recession, 1 year, 3 year, 5 year, 10 years after the announcement of the recession, the market is very bullish one. So when the media keep painting that what is the worst, you can feel it, everybody is down, don't talk to me about investment, that is actually the bottom of the market. So it may not be a bad thing if recession happens. Okay, then you know you can show hand already, right? When the recession is not announced, it's like not here, not there. You also won't dare to go and put in a lot, correct or not? So on the flip side, right, if you look at the brighter side of things, okay, a recession may be a positive outcome for stock investors, okay, especially, right? So just remember that a recession is a bottom indicator. And now let me tell you the other scenario, right? That it may not be a crash, right? A recession may not happen as well. Okay, why? So these are some of the positive indicators. We all know that this is the election year, right? Not just for Singapore, but also for the US. The US election year typically is a good year for stocks. Okay, so year 4 is the election year, right? You can see on average, it is the highest return among the 4 years. Okay, and it has 75% chance that it will be a positive year. Okay, so this is the election year, so it should be somehow good, right? One way or another, okay, or at least the US will make it look good as much as possible. And this is another positive indicator. 2020, if the S&P 500 did more than 10% return for the first half of the year, okay, if it goes up more than 10% for the first half of the year, usually the second half is also a positive year. Right, so you can see for the rest of the year, majority of time, of course, yes, there were some periods that they didn't, okay, but for majority of time, it's a positive year, right? So for this year, S&P 500 went up 14.5%, which is definitely more than 10%. Okay, so again, the odds is that it's likely to have a positive end to this year rather than a negative one. Okay, so second half of the year will also be positive, but may not be as positive as the first half. Okay, so that is for anyone's guess. All right. The next thing I want to ask, okay, is that do you think we can go back to near 0% interest rate within the next 5 years? Right? Because we talk about Federal Reserve cutting rates, right? What do you think? Yes, no, yes, no. I don't need to know the number, right? What do you think? Do you think we can go back to near 0% interest rate within the next 5 years? Okay, I see a lot of no, 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 no. Wow, only one yes. Only Henry say yes. Majority of you don't believe lah, right? I also don't believe lah. Okay, I don't think that we can go back to that era anymore because simply that inflation problem has not been eradicated, right? In US, it's still like hovering around 3%. It's not below. It's not at 2% anytime soon. So if they cut and go close to 0%, right? There's a risk that inflation may come back. Then after that, if they end up in a stagflation, which means low economic growth plus high inflation, that's the worst situation that any country can get into. So I also don't think that they're going to cut to zero. I think for the next 5 years, staying above 3% may be the new normal. Okay, 0% is not normal anymore. And what does that mean? There's this debate that value stock versus growth stocks, right? Now, for the last 10 years, everybody liked growth stocks because growth stocks have done very well, okay, versus the value stocks. Value stocks have not done well. And this is a JP Morgan research, huh? And the environment has to be right, okay, at least from an interest rate and environment perspective, okay? So these are the 10-year treasury yield, treasury rates, interest rates, 0 to 2%, 2 to 3%, 3 to 4%, 4 to 5%, and more than 5%, okay? The green bars is the return of growth stocks, average. Value is the gray bar. Okay? If you realize, most of the time when the interest rate is low, which is characterized by less than 3%, growth stock does well. Growth stock will outperform value stocks by large margin, which is true, right? Correct or not? In the last 10 years. Okay. But as you see, when the interest, the normal, the normal interest rate environment, okay, this is our new normal, right? More than 3%, right? Your value stocks will start to have a higher chance of beating the growth stocks. Okay. So we might be at the inflection point that this may turn around. Okay. Why? Because there's always a cycle. There are periods means many years, that value don't do well, growth do well. there are periods where value do well, growth don't do well, right? More than 10 years, the cycle is very long. And then for the last 10 years, what we have seen is that growth do well more than value, right? So it can just step back again, then value is invoked again. Okay. So I will also say that it's timely to watch out for this reversion, right? This mean reversion effect. Start to pay more attention to value stocks. And of course, value stocks also includes dividend stocks and things like that. Okay, they generally, their characteristics is that their growth rate is not very high, but they are already producing a lot of cash flow today. Why growth stocks usually don't do so well in higher interest rate environment? Because their discounting factor is higher, right? So the future value get discounted more to today's future value get punished because the discount is high. So the today's value becomes lower. Okay, so that's how to reconcile that. Value stocks, they produce cash flow today, you don't need to discount one. So the value today is to the value today. So therefore, there could be a major transition point for growth to value after all these rate cuts stabilize, of course. Okay, because now everything is very dynamic. You won't see the pattern evolving so fast yet. Okay. So there are two possible scenarios. One is just a correction, right? A soft landing is still happening. Economic does slow down, but not as scary as what people think it is. And the carry trade unwinding impact dissipates. Okay? It's just a temporary issue and it just go away, right? The volatility spike has happened and it just the effects just wear off. And the market rebounds well on the bull run. Okay. And the second possible scenario is that a crash happens. Okay. Market lead the economy with a crash. Crash first, then economy is weak and recession officially announced. As I said, if it happens, it's not going to be this year, it's likely going to be next year. But the market will crash first before that happens. And once a recession announced, market bottoms and a new bull run emerges. My view is at this point in time, I think likelier is scenario one. Okay, it's likely a correction. I do think that the yen carry trade is temporary, right? But definitely impactful because I think quite a lot of people over leverage, right? So they have to take out their position and that causes a spike in the market. But I think eventually it will tone down. US recession is longer term risk, as I mentioned, but the economy remains strong, right? Especially with the services PMI shot back up again, and US GDP growth is still at 2+%, at least for the last quarter. And it doesn't seem like there is a very clear reason why the US economy is slowing down. And even talking about unemployment rate climbing up at 4.8% is nothing to be alarming, right? The alarm will only sound when it's near 10%. Okay, so it's still far from that. And therefore, I don't think the recession risk is very high, okay, at this point in time. Unless more data come out, right? Then if that risk increases, we will need to relook at the situation. Okay. And of course, if that economic data continue to be bad, you expect the market to be volatile once more, right? And also think that on the longer term, in the next 5 years, I don't think interest rate is likely to go back to zero, and maybe you'll stay above 3%. And that is a new normal that we need to contend with, and which means our loans to buy durable goods will be higher than what we are used to in last 10 years. And this kind of environment is usually better for value stocks, dividend stocks, and that may cause a shift in the market rotation.